Welcome to another edition of Around the Table with Stacy Smith. We're talking about the economy and investing today. This week, investors around the country are faced with two issues that could be critical to your well-being. They are the inflation and, of course, the resurgence of COVID, especially in Europe. So who better to talk about all of these different kind of topics that could affect you and your investments and just the economy in general, but our great list of panelists that we have right now. I would like to introduce you to Carrie Coghill. Carrie is the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She's recognized as one of the nation's leading voices and on financial advising. As we go around the table, we find Frank Rossetti. Frank has been advising clients for 50 years. Frank helped to establish Harvest Financial, where he is the executive chairman. Across the table, we find Kim Forrest. Kim is the chief investment officer and founder of Boca Capital Partners. Kim has a dual background in both finance and in software engineering, and you may have seen Kim in her many appearances on Bloomberg, on Fox, and also on CNBC. And the last panelist at the table is a familiar name to a lot of Pittsburghers, Bob Fragasso. Bob has been in the investment advisory business for nearly 50 years and is chairman of the chief executive officer of Fragasso Financial Advisors. So I want to welcome all of you on this Monday before Thanksgiving, and we've got a lot to talk about. So let's dive right into it. Let's start with inflation. Quinnipiac University released a poll late last week in which those polled were asked what they thought was the most important issue facing the country right now. Among the issues were the economy and inflation. In fact, 60% of those polled said the nation's economy is getting worse, and nearly 70% say the increased prices for items like food and gasoline are causing them to change their buying and spending habits. Now, polls and what happens in reality don't always jive, but prices are rising. And also, there is a growing concern that inflation is not transitory, as the Fed believed that it would be. And there are growing indications the Fed may act this year to raise rates. JP Morgan is the latest Wall Street firm to tout that opinion. So let's tackle this one. Frank, I'm going to start with you. Your quick take on inflation and how this may be playing out here in the near future.
Well, there's no doubt that we have inflation at higher levels than we've seen in years. But if we, again, roll the clock back briefly, at the height of the COVID response back in 2020, we had a couple of months where we had deflation of about 1%. And if you average that out over the time of this COVID thing's been going on, we're probably going to end up running in the neighborhood of 4%, which Bob tells us is the high end of the normal range over the last 70 or 100 years. That being said, we also have to remember, if we go back 20 years, the government's been trying to create inflation just to minimize the debt that they've been incurring to bail us out of dot-com collapse, 9/11, the bank collapse, and followed by COVID. I mean, we've had four major events in the last 20 or so years that the government's had to pay for one way or another. And they've been trying to create inflation just so those dollars will have less value going forward. And they've failed largely because of technology, as Kim has pointed out in the past, and because the Chinese manufactured goods come in here and help hold inflation down. We are now moving towards a desired less dependence on foreign goods, which will cause inflation going forward, but we still have the technology wildcard to hold it down.
All right, that's interesting. Let's go to Kim. Since Frank mentioned you, your quick take on this.
Sure. Well, I mean, and I have to validate everybody who's watching. Of course, inflation is here, especially if you fill your gas tank and go to the grocery store. Like, those are the two places that you're going to see it most. And it's almost horrifying, right? Because you can remember last year what you were paying, kind of. And it was a lot less, maybe half at the gas tank, right? So I agree with Frank, though, that it is likely to be transitory, and it's largely because of technology. This is an unpleasant thought for a lot of folks, but it works out in the long run. The technology, or that capital and labor are substitutes for each other. So if you don't have money, you use your time and yourself. If you do have money, you can buy a productive tool And that's what's going to help the economy kind of drift back. The thing that I have to say, though, about the word transitory is I think the Fed has done a poor job about defining it. Like whenever you're in pain, transitory is about the next second, right?
Mm-hmm.
But now that we're in pain and in inflation, I still believe it's transitory, meaning it's not years long, probably months long. And I think the Fed could come out and, give us a definition of what they think transitory is. But it's always rough predicting the future, as every panelist knows here.
That it is. Bob, I presume you would agree that it's tough to predict the future, but your quick take.
Yes, inflation is a non-homogeneous word. In other words, when I say inflation, people, inflation? Well, 1% is inflation, 3% is inflation, 10% is inflation. So inflation is not axiomatically a bad word. Inflation is symptomatic of a growing economy. As Frank pointed out, we don't want deflation, far worse. So we're looking to, and also as Kimberly pointed out, what's the duration, and what I point out, what's the amount of inflation? So let's look at the indicators. We talked about last panel discussion that there may be some movement toward onshoring some of our supply chain. And in between our two panel discussions, GM and Ford announced that they're building chip manufacturing plants domestically. We also have found that some of the strain on the ports is lessening. So let's not see inflation as some sort of boogeyman that overshadows everything. Inflation is here. What will it be, at what level, and for how long? And the indicators indicate that Kim is right, that it can be transitory.
All right, could be transitory. Carrie, your quick take on this.
Well, there's no doubt that people are feeling the effects of inflation, as we've seen in recent polls. And this debate over whether it's transitory, which, by the way, means that it's here and it's going to fade out, or it's sticky and is going to be with us, in both camps are right. We have supply chains that are easing. We have demand, $6 trillion that was printed, which means inflation will be with us for some time in the future. But what consumers need to realize is that on the flip side, we now are making more money, we have better personal balance sheets, and we have the lowest level of personal debt that we've had in years. So this idea of inflation is nothing to get too alarmed about because we can absorb it. And just because there's higher inflation doesn't mean that it's hyperinflation like we had in the 1970s.
All right, Carrie, thank you. I'm going to ask each of you for a very quick response, and that would be that the Biden administration has decided to keep Powell on as the Fed chair. Is this going to have any effect, you think, on strategizing down the road here on inflation? Carrie, since you're on right now, go ahead.
Yeah, I don't think that I think the good news about this decision is that people don't like change. So we know what we're getting. And I think at this point in time, that's critical. What we have to be mindful of is that how we're dealing with this inflation is different than the way we dealt with inflation in the past. And what I mean by that is that holding off on raising interest rates may actually be a mistake versus getting ahead of the curve, seeing interest rates go up a bit. It's not the end of the world. It's actually a good thing when we see interest rates go up. We just want it to go up in a very measured way.
Okay, great. Bob?
Inflation, I agree with Carrie completely. Inflation and interest rates are in lockstep. But interest rates, again, is a non-homogeneous term. When we talk about that, we're talking about the Fed's dictated interest rates. And your basic question, Powell remaining as Fed chair is a good thing. It's a steady hand. It's a measured hand. He commands respect among the other governors. So that stability is going to be good. Carrie's right. Interest rates will edge up. The question is how much and over what period of time. That's not bad. We're at an abnormally low interest rate period. We have been in an abnormally low inflation period, which means we had slow growth. Yep. So let's get normal inflation, let's get normal interest rates, and let's do business.
All right, good. Kim, your take?
I think it's a great take, and here's why. I will take somebody that has been a market participant over somebody that has been solely an academic. And I think that is the difference between the two people that were being considered. And Powell, he may have let inflation get away, but we'll see in about a year, right? But I think people that have actually been in the market, doing stuff in the market and understanding how things actually work, not just writing papers on it, it's a huge, huge boost.
Okay, great. And Frank.
I pretty much agree with what everyone is saying. We probably could benefit from a higher interest rates than where they are today. But as I think Bob said, what's higher? I think historically, Kim, correct me if I'm wrong, but I think somewhere along the line of 2% for an overnight rate is basically normal. 3 or 4% for the 10-year bond is more or less normal. And 5 or 6% for the 30-year bond is more or less normal, if there is such a thing as normal. And that being said, that's a lot higher than where they are now. I think the overnight rate's at about 25 basis points, 1/4%. I think the 10 years at about 1.5, 1.6%, which is materially lower than what might be considered normal. And the 30-year is under 2, I believe. And that's 1/3 of what it could be and still be healthy. I don't think higher interest rates will prevent anyone from borrowing money to venture into a good business. My concern about rates, using interest rates as the check for inflation, that would presume that people are actually borrowing money. And corporations have more cash on their balance sheets than they've had. People have, as Carrie pointed out, the strongest balance sheets they've had in years. And I'm not sure it's going to mean a hill of beans to inflation. I think supply chain and the cost of labor is going to have more to do with inflation than the cost of money.
All right, great. Let's move on to another other issue that I think could be a big one. That is, of course, the resurgence of COVID. There are moves by many European governments now to try to reimpose restrictions because the infection rate is surging again, especially in Europe. That has caused some rioting in some areas by people who say they had just had enough with restrictions and how those restrictions are having a negative effect on their businesses and their lives. So, Carrie, let's go to you. What is your quick take on this resurgence of COVID? Is it going to have an effect on our economy?
Well, you have to look at supply chains. That's where you start to say, okay, is the supply chain issue really going to go away, depending upon where these lockdowns are and where you're getting your product from? So surely if we see lockdowns in Germany, that will have impact on imports coming from Germany, and Germany is a huge exporter. It's the most challenging dilemma that I think we've ever had to deal with. And the reason is that we're dealing with a health crisis. And the reason for the lockdowns really have to do with the health system and not overpowering the health system. And, where's the priority? Is it with health or is it with money? And in this case, the two are really intertwined. So, we're all frustrated with it. But I think at the end of the day, you have to say, if you're in one of these countries, or potentially we might face something like this here in this country again, at least in pockets, no one wants this. But you really have to look at what's happening at the hospital system to say, okay, is this necessary or not necessary? And it's all well and good. Like, we can say, okay, we're not going to get COVID, but what if I have a heart attack and there are no hospital beds for me to go and get treated? It's a very complex situation, but economically, absolutely, it has impact.
All right, Bob, your quick take.
We're dealing with COVID. It's going to be a chronic condition. The question, like the flu, like many other diseases and circumstances. I don't believe, first, everyone should be vaccinated, flat out. That's what's going to solve this. But also quickly say, not everybody's going to be vaccinated. All right, we have these debates within our company, within our families. Let me give you a quick analogy. We know that people shouldn't smoke cigarettes. We did not mandate that people quit smoking cigarettes, but we put a crash publicity campaign out that went over a couple of decades. Far fewer people smoke cigarettes today. Thus, severe lung cancer has decreased. So I think we need to do the same kind of PR. You can't tell someone who's convinced that they shouldn't be vaccinated that they must be vaccinated. Then you're going to have people stepping out of the workforce. So we have to put a significant social pressure type PR program out, and I think we'll get more voluntary compliance. Either way, the answer is for the majority of Americans to be vaccinated. Overseas, they're catching up to us, but they're trying to catch up to us.
All right, Kim, your thoughts about COVID and the economy?
Sure. Well, I think it's more, well, there are practical issues, right? But when we're reading about people in Australia and Austria and places that are far flung and seeing these really harsh lockdowns going on, I think it's a matter of psychology to the market as well. And I think you really have to gauge that. Now, I'm an optimist, and if I see the market selling off on some other countries that is not, their news about their lockdowns, that again doesn't impact the really global supply chain in a meaningful way. I'm not sure what we import from Austria. I'm sure it's something, but not a great bunch. But if that pushes the market down, I'd use that as a reason to maybe look at the stocks that aren't affected by that and buy. So, even in times of turmoil, you have to have your investing hat on.
Okay, great. We'll wrap it up with Frank.
It's all very interesting what we think here, and we all pretty much, I think, say that we have to do a better job with the vaccine worldwide. Worldwide, it's a little more difficult because our government's not buying vaccines for the Austrians or the Australians. We are being accused of using the manufacturing capacity of vaccine to get it and preventing it from going elsewhere in the world. I don't know the truth to any of that. I suspect there's some truth to it, but like most things, it's not totally the problem. As these vaccines get distributed around the world, I would expect this to slow down. I also expect that this is going to be like the flu, and it's just with us, it's going to be endemic rather than pandemic, and we're just going to deal with it. And hopefully some people will change the way they live as a result of it out of fear. And in time, that fear should wane, but I don't know what that means. I don't know what time means in this case.
But your basic outline on this, Frank, is that you don't think it's really going to have that much of an effect on the economy down the road.
Now, I think corporations are in the business of making money, and they'll find a way to make money no matter what's going on.
Okay.
And our
great.
job is to figure out who's going to be successful at that.
And an interesting point on top of that, we just went through the worst possible scenario ever in terms of our own lockdowns a year ago. And our economy has actually, in many ways, thrived. And I think that the shift it all converged at the right time. Like Zoom was here. God forbid this happened 10 years ago. It would have been much different. But there definitely are winners and losers when it comes to businesses locking down or the impact on the economy. But I think we're figuring it out. And I think all businesses, regardless of what business you're in, are saying, okay, what do we do when there's another pandemic? So I'm going to go with Kim on this one. I'm pretty optimistic about where our economy is and where our consumer is. And we're 70% driven by the economy. So it's kind of hard to bet against that right now.
Great. All of you help people invest their money. Of course, people invest money to make money, and a lot of people do it to help them retire through their years of retirement. There's been a calculation that's been used in the past for years called the 4% rule. Basically, it means that to make your savings last through your retirement years, you should take no more than 4% of your investment funds to live on each year. Well, there's a report from Morningstar that rule may have to change to 3.3% instead of 4%. So basically what it means is, let's just say you have $1 million in retirement funds when you retire, and instead of withdrawing $40,000 or 4% each year, you can now only withdraw 33% or 33,000, 3.3% or 33,000. That, of course, could have a dramatic effect on a lot of people's outlook on how they're going to live their lives when they do retire. Bob, as I say, you've been investing, helping people invest their money for some time. Your quick take on how investors should react to this, or should they at all?
I think to draw a conclusion, you have to look at how that calculation is done. So that report is a attention-getting headline. You're going to withdraw less from your savings. How that's calculated is based on several factors. How much can you expect from the total return of your portfolio? Now, again, that's not homogeneous either, to stay with that term, because if you have an all bond portfolio versus an all stock portfolio versus a half bond and half stock portfolio, your expected return is different in those three examples. So that's one factor. The second factor is, what is inflation? What is inflation expected to be? We just had a discussion on that. Then if you get a total return, let's call it 7%, that you believe you can get from a portfolio average over time. I'm not guaranteeing it. I'm not predicting it. I'm using it as an example, but it's a historically supportable example from a balanced portfolio. And we have 3% inflation. You can draw 4 from that 7, plowing back 3 to keep your capital growing in keeping with inflation. So headline, oh, you're diminished from 40,000 to 33,000. Well, no, you're not. Let's go through the calculation in your situation, your portfolio, what our expectations are longer term, not for next month, both on inflation and rates of return, and what's left is yours.
Kim, your thoughts?
I agree completely with Bob, but I'm going to put a new spin on it. Earlier, Frank pointed out what the old rates of interest were, going up to, well, the 10 years, the big one for us, like 2 to 3%. I don't believe we're ever getting back to that area. And it's because I think the US is trapped in low interest rate environment by our two largest partners, which are Europe and China. And I don't think either of those locations are really hot to increase their interest rates. So the US has to maintain a comparable interest rate. So I think for probably my lifetime, we are not going to see 3% on the 10-year. I know that's a bold statement, and it depends on how long I live, right? I'm trying to make light of this. So in light of that, I don't think that we can go back to reversion to the mean where like 7% was an average return. I think we're much higher than that. And so I agree with Bob that, you can take out some money, but you're making probably more than you're using, and that your nest egg should be able to continue to grow. But mine is predicated on the low interest rate environment being trapped by our two largest trading partners.
Okay.
If I could piggyback on what Jim said, because I think it's important. Again, as we both said, the makeup of the portfolio is critical.
Yes.
If you have an all bond portfolio and you're getting 2.5% from your bond portfolio, you're not going to be able to do any of this. So you have to have a balanced asset allocated portfolio for the equation to work.
All right, Frank, your thoughts.
We've been doing a lot of work with inflation for individuals as opposed to the general inflation rate. Today, the inflation factors include rental properties. Most of my retired people for now own their home, and they already own it. They don't have a mortgage or much of one. So that piece, which is a big piece of the inflation equation today, is eliminated. They already own the home. They aren't paying rent that's going up whatever percent a year. The gasoline, as we age, we drive less. So gasoline's going up, but if you're not using as much, it's not as big a problem. So everyone needs to figure out what their inflation rate is based on how they spend their money. And for those of us that belong to country clubs, they go up at 5 or 10% a year. All right, which I've always wondered what it ever had to do with the inflation rate, but they do it and they get away with it. So, these things are different for everyone. and their portfolio needs to reflect how they spend money and how they plan on living. And to add one more thing, back when I was much younger and I held the clients that are now my age, or the age I am now, to this spending pattern that was to go out a lifetime of 20, 30, 40 years, my father, who then was my age, said, Frank, take it easy on your retired clients. As they age, they will spend less money because they will lose the interest in doing it. So let them enjoy their younger years and spend a little more, and don't be so harsh on them later because they're not going to spend as much money anyway.
Okay. Carrie, wrap up this discussion for us.
I really don't like to follow rules. So this kind of flows right into that. When you see something like this, it's kind of a red flag because, as everyone has pointed out, these are highly personalized decisions. Number one, based upon the composition of your portfolio and economic issues like inflation, which then becomes a math problem. But the thing that people are really missing, and Frank was discussing this, is the issue of how do we want to spend our money? And maybe I want to spend more while I'm younger and less when I'm older. But even more important to that is this assumption that we're going to live off of our earnings and never see our principal go down. And I just don't think that future generations are going to have the luxury to save enough money during their lifetime so that they can preserve their nest egg and then give it to their heirs as an inheritance. So to make that assumption that we're going to keep this nest egg in place really could be affecting the standard of living of the client. So we have to have that conversation. How much do you want to leave to your kids? Do you want to leave all of it? Are you willing to sacrifice your standard of living? Or maybe let's identify a dollar amount so that we can run the projection and we can eat down your principal to that point by the time your life expectancy happens. Or do we get more creative and purchase life insurance so that we can, I don't know if anyone recalls the book probably 20 years ago, How to Die Broke, where they say that the check to the undertaker should bounce. And I'm comfortable with that as long as I have life insurance to accomplish the goals that I want to accomplish after I'm gone. So again, to everyone's point, these are very personal decisions. There is no one size fits all. In our industry, we try to, put information out there. As Bob said, this is a headline and it gets people's attention.
All right, Carrie, thank you.
Every
segment, we like to take a look at a particular stock that one of our investors here, our investment analysts, can tout, and that would be Kim Forrest. So, Kim, one of your stocks, Xilinx, is up 40% since you said it, and another one's up 1%. So, what do you have for us today?
Well, this is probably a little less buoyant than Xilinx, we'll just call it. But seriously, J&J, Johnson & Johnson, the ticker symbol is JNJ, or, N, not and J. They announced last week that they're going to be breaking the company in two. And whenever you hear a company is going to take one part of itself and split it off, what that basically says is that part that they want to split off is growing faster, and they want to have recognition for this. So you should always pay attention to when a company is breaking itself up. So what they're doing is they're going to have Johnson & Johnson, the consumer products division, and that's baby powder and aspirin and stuff that you would buy at a drugstore. But then they're going to have medical devices and drugs in another company. So the medical devices and drugs probably is going to grow faster than the consumer end that's going to remain. However, I'd expect a pretty good dividend off of that consumer product. So maybe you buy it now, keep both, but one is going to be able to outpace the other based on its growth potential. So take a look at J&J, but also consider your personal financial standing and whether or not this is a good advice for you.
All right, Kim, thank you.
Investor professional.
All right, Kim, thank you. And I also want to thank everybody else on our panel here who with us today, Bob and Carrie, Frank, Kim. Thank you all for joining me for another edition of Around the Table with Stacy Smith, and we'll see you next time, and have a happy Thanksgiving.
Thank you, and same to you.
Thank you.
This has been a CBSN Pittsburgh special presentation. We now return to our scheduled programming in progress.